Good morning, I'm Devin Shute. Welcome to the TRG Money Minute. So the trade wars continued to dictate market movements last week. President Trump tried to calm tensions by delaying certain tariffs till December. However, China did retaliate with more tariffs during the week, and this resulted in extremely volatile world markets due to the ongoing uncertainty there. We have had China announce measures over the weekend to reduce borrowing costs for companies, and this is in an attempt to boost its economy that is starting to feel the effects of the trade wars. The debate over the proposed NHI continued last week, and although the government has set itself a 7-year deadline, privately officials have confessed that any meaningful implementation could take decades. Discovery Holdings had a rough week last week as it was battered by concerns over the NHI, instability in the UK, and an uncomplimentary research report. The share is now trading at levels not seen in 5 years, but we believe that the market could have overreacted during this perfect storm. Despite chattering to the contrary, the International Monetary Fund, or IMF, released a statement to say that SA does not need its help and can resolve its own financial issues. This doesn't remove the risk of us ending up at the IMF's door in future if we don't implement the necessary structural reforms. We saw some life from the South African consumer. Retail sales grew by 2.4% in June, and these are expected to remain positive during the remainder of the year, supported by discounted prices and slightly lower interest rates. And lastly, South Africa announced a waiver of tourist and business visas to South Africa for visitors from Qatar, Saudi Arabia, UAE and New Zealand in an attempt to boost tourism. More of this, please. Thanks for watching. Have a good week.